Hi, this is Randy Finney with Right Side of the Chart, and this is a early to mid session update for Wednesday, May 7th, 2025. It's 10:48 a.m. Eastern Time. Excuse me. As I start the video, today, of course, is Fed Day. To kind of reiterate what I say every FOMC meeting, or most of them, and for a while there, that didn't matter when the markets weren't hypersensitive to rates and inflation. Obviously, it's a different story at this point in time. So the markets will hang on every word Powell said. Somebody asked yesterday, looking for an update on my view on interest rates. Well, my view is, there's really no guessing what's going to happen. I posted this link. This is the called the Fed Watch tool. You can Google it. It's under cmegroup.com, or just Google Fed Watch tool, and they'll tell you what the probabilities are. And this is folks betting on it via Fed funds futures. I'm gonna guess that 99% of the people listening to my voice have never traded those, may not even know what they are. So what it is, typically pros, institutional traders, professional traders will bet via Fed funds futures, buying contracts that will bet whether the futures, there's going to be an increase or decrease in rates, where they're going to be, and being that that's typically smart money, they're accurate. When you see a 98% chance, and I say this every Fed meeting, the one thing this Fed and any Fed chairman going back to as far as I can remember, long before Bernanke and et cetera, they do not surprise the market. They will not and do not. They're afraid to. They over telegraph what they're thinking and what they plan to do. So my point is, you're not going to see a 98% chance of no change in rates. I would fall off my chair if that happened. The market would break. Something crazy would happen because too many institutions and traders would be not expecting it. So that's it, guys. We're not going to have any change in rates this meeting. You can look at the dot plot. You can play around with this. If you just click, you can see what the probabilities are at the other meeting. So, my get my I don't really make predictions to interest rate. What I do predict is the equity markets, and and I shared my thoughts. If my longer term scenario plays out, if this market's going to take a new leg down, which if it does, it's going to be this year, 2025. It's going to be probably soon. I'll get into that in the charts in a second. About the only guarantee I give you, the Fed will be cutting rates because of the falling stock market, and the fact that the stock market's falling, housing market's already turned. I'm as confident as I've been probably in a very, very, very long time that a recession is likely imminent, baked in the cake, and probably has already begun and will be declared in hindsight. Therefore, you're going to see, falling asset prices. And it's simple, and I've said this before, where all these economists are all over the place, is why there's going to be no recession, why there might be one. It's simple. The charts are the charts. Technicals will play out. They've already started to play out. The falling equity market, most people, especially the spenders, if you will, no offense, but the vast majority of consumer spending is done by the haves, not the have-nots, on especially discretionary items, which have higher profit margins and really lube the U.S. economy. And when their stock holdings fall and their home prices, remember the wealthy, those are the two big. That's where most of their money is, in the stock market and their home or homes. And again, they are the drivers of the economy, and disproportionately own most of the wealth. And so it's simple. Market goes down, consumer spending, and you can just plot the consumer confidence charts with the stock market. I always say consumer confidence is a coincident indicator. It's going to move up and down with the stock market. And so that's that, guys. Whatever. It either works out or it doesn't. And that's the other thing about any single trade. I talk more about the equity markets and everything because that's kind of all-encompassing. And within the stock market, you have all these subsectors and individual opportunities, long and short at any given time. But remember, it's only one trade, if you will, if you're trading the indexes, and should only be one trade in a diversified portfolio with spreading your bets in other directions. So there it is. You can play around with the Fed funds tool and see where the market thinks rates are going. The one guarantee I can give you about the Fed is they've always been reactive, not proactive. And they tell you, Powell's data dependent. So as I've showed you many times in the past, I'm not going to get into in this video. The job market has turned, and they're going to wait till the numbers come in, and by the time they realize it, they'll be behind the curve, and then they'll start cutting to play a game of catch up. Okay, I had to pause the video there, take an important phone call, and it took a good 10-15 minutes. So anyway, I'm trying to think we were wrapped up here. That's that. So no change in rates today to be expected. And as always, and I did say this in my reply to that comment yesterday, most importantly, it's not about what the Fed does. That's almost always priced in with a near certainty or a high probability, at least. But what matters is afterwards, you're going to have Powell gets on, does his dog and pony show starting at 2:30 p.m. And the market will hang on every word he says. Basically, is he going to come across as more dovish or bearish? And again, even then, it doesn't even matter what he says. Most important is how the market reacts. I can tell you time and time again, I've seen the Fed do something or say something bearish, dovish or hawkish, where you would think the market would go one way and it goes the exact opposite way. So again, it's what the market's reaction. And then finally, and again, if you followed me for any period of time, you've heard me say this every single Fed meeting. I say it during big earnings reports. It's not the initial reaction that counts. In fact, it's I don't think I can ever recall after a big Fed meeting an initial reaction that wasn't at least faded. What I'm talking about is the initial spike after the announcement or the FOMC or the press conference, seeing a spike down or up only to see it reverse. And even then that's often reversed. In other words, I'd call it post FOMC noise. Don't read too much into it. It's not to say that the initial reaction can't be the lasting reaction. All I'm trying to say is that it quite often you see big swings, several percentage points sometimes in either direction before what I call the dust settles, and that can take a day or two. And then on that, finally, one other thing to add there is my preference is, I'm going to go over to my charts here on trades. I've shared this strategy very often. What I will do personally, if I have any trades close to being stopped out, I'm a big fan of OCO orders. One cancels the other. They're also called OCA orders, depending on your broker. One cancels the other, or one cancels another. Same thing. It's two orders. You buy a position. Let's say it's QQQ, and let's say you're gonna in this case, let's say short, and you're gonna target, let's say, down here, 445, and your stop is going to be right here. You initially set a buy to cover that order to close out at your profit target, and a stop loss order, and you assign them. They're tagged together in an OCO, means one cancels the other. And what that says, if QQQ goes up and hits your stop, it's going to automatically cancel that order for you. Likewise, if your profit target's hit, it's going to cancel that order for you. And you always set those good to cancel. However, during periods where you can almost guarantee or expect a lot of volatility, I will often can't temporarily pull my stops on any positions close. If I still like the trade, again, it's trade specific. Every position's different. My outlook is different on every single trade at any point in time. But generally, I will do that. Pull those stops, but I'll leave my price targets on. And I do this on earnings trades. If I hold trades into earnings, which I'll do at times. And the beauty of that strategy, I can't tell you how many times it's gone down just to hit my price targets. Because if you follow me for a while, my price targets, especially my final targets, or even all targets, usually get a reaction there, a reversal when hit. So my goal in any trade, obviously, is to not be stopped out, but to have my price targets hit. Likewise, in volatility, sometimes they'll just, the volatility will spike a position right up through your target, only to go on to see that trade hit. Ultimately go on to pan out and hit my target. Now, yes, this does have the risk when you pull stops that there's no guarantee you could keep going up. And then you have to make the tough decision. Okay, post-Fed is over, volatility is abated, it's Friday now, or it's next Monday, we're still going, the position's going against me. Yeah, occasionally that will result in larger than expected losses. But again, from my experience over time, there's been more instances where I've been saved from having my stops clipped, a brief pop up into or just above, or again, vice versa if you're long. So that's my preferred strategy. All right, now let's just talk the charts real quick. I'll go over in this video just the market, and we'll just stick with QQQ. It's the same thing on SPY, really. I'll hit on that in a second briefly, but QQQ, to kind of recap, where we just got rejected, rallied back to, and reject off the 200-day moving averages. There are no guarantees, but when you go back in time, and I've covered this ad nauseum recently, how well especially the tech-heavy stocks and indexes and sectors behave to their 200-day moving averages, meaning the primary trend is bullish when you're above them. You want to buy pullbacks to them and stay long, and then when they're taken out, the trend changes and you want to short rallies back to the 200 days. It's a very simple strategy. It's worked time and time again, especially in recent years. Just like the last bear market, shorting rallies back to the 200, either simple or exponential, or both. I usually give it the latter of the two, and that's it. So we're in close proximity, and a single day move above there, especially right around, let's say it's today after the Fed or tomorrow, early next week, could do the trick. But most importantly, we're still smack in my bounce target zone, which is where I expected this rally to go to, and my plan was and still is to scale back into shorts up to, but not above the top of it. And then if we start moving above 500 on QQQ, I will be scaling out of that position. I don't have a single exit point. It'll be more of a read the charts at the time. How do things look? How do the Mag 7, 8 stocks look? How do the other sectors? Many, many other things there. And that's it. So it's one trade. The RR is still phenomenal if that's the case, by re-entering, scaling back in, building a position here up to, but not above. And I really don't want to add, I won't be adding above the 200-day moving averages side. That's what, if we pop above them, I'll sit tight. And if we fall back below, I may continue to add to my position. There's plenty of room to add. I told you it's not an aggressive all-in moment, in my opinion. And then, of course, the longer-term targets, if you're new to the site, remain all the way down here. T7 is my current final target, which is still, from where we're at now, a drop of about 46% or so. So, stop somewhat, scale out point above the 500 level. You're talking, 3% or so, give or take. That is a phenomenal risk-reward ratio. Meaning you're risking very little to the profit potential. And so, again, if we get above the 200s, we get above the $500 level on QQQ, I will share my thoughts at the time. That I guarantee you. Until then, nothing has changed. We're in that bounce target zone, which I continue to maintain and believe that any rallies, especially to the, back to the 200-day moving average, and we've already hit it and rejected off it. So ideally, it would be a bit atypical to see another run and punch through there. So that's why I get, at this point, I'm more apt to add on weakness, showing that we've been rejected off the 200, especially a drop down below the bounce target zone, than I am on strength. I'll just sit and hold tight. Same thing on gold, which I'll get to in a second. Okay, and before I move away from QQQ, we're just going to go over the top components. We're going to talk about, other than price resistance and 200-day moving averages. Okay, those are two different types of resistance levels. Again, I've showed you in the bounce target zone. There's SPY. SPY also, I gave you a comparable bounce target zone, also shaded in the purple box right here. There's my box tool. And we made it up to about little north and halfway up in there. And also, if you turn off all the lines, you can see here, SPY so far stopped cold between this red line here is the 200 exponential, and this is the 200-day simple moving average, and there's where SPY stopped in between the two right now. It's kind of split the difference, split the crosshairs there. And again, if it rallies up to the 200 simple, just like it did here, That would also provide an objective short. It would also be in my scale back in zone. So I watch both these indices very much. And you can see in the last bear market here, it popped it briefly, but at the same time, I believe QQQ was stopping on the rallying into the 200s and got rejected. Here you hit the 200 simple to the button. You hit it again there, had another pullback, and finally took it out here. And, you know, sometimes they'll move through for a day or two. This is what I was talking about before. That's why it's not a complete elimination. It decreases the odds substantially, especially if you don't fall back quickly. But again, when you look at these indices, sometimes one or the other will punch through there temporarily. So, you know, they're not the be-all, end-all. It was a brief overshoot, but we also went long that morning. We covered all our shorts and went to a hard long because of the QQQ and many other things hitting there. So, all right, so that's that. Okay, that's one type of resistance level. I'm sorry, two. Price, which of course I had, you know, price resistance levels. The big one there being also that 499. I call it 500. It's basically the bottom of that topping pattern there. Now we're going to talk fibs. We're not talking about lies. We're talking about Fibonacci retracement levels. And so I go here, go to this daily board right here, and I'm going to show you. Here's the one I wanted. Okay, so forget about I have some other annotations on here, and I apologize. I need to clean this board up. I need to move these annotations over, these trend lines and things. But what you can see here, this purple line right here. So right here, this is the all-time high in QQQ. And this is the recent low right here. And this purple line from here to here, right here, covers that from that point. So you can see a little dash line. That's the high, that's the low. And if you're not familiar, look these up. I incorporate them into my trading. You would be surprised how well and often these things work. And what they are is typically you have a retracement in a larger, again, I'm going off the assumption that my longer term analysis is correct. If I'm proven wrong, what I've been doing in this video, and I do every day, I'll tell you where I start to be wrong. One of those levels, again, if we exceed 500 on QQQ, and of course, if we, you know, the other things in the 200-day moving averages, like I said earlier, and these Fibonacci retracements. So typically in any trend, whether it's a bullish uptrend or a bearish downtrend, you have corrections along the way. Those are counter trend moves to the primary trend. Those corrective moves or corrective waves are typically contained, and again, this is from my experience, but you can look it up. And, you know, some people might use different levels, but typically anywhere between the 38.2, I know it's hard to see in the video, but that's what that says, 38.2, that's in percent, up to the 61.8. In other words, if you take the move from the high to the low, right now, this purple dash line, I don't know if you can see it in the video, if you're not using a computer or if your monitor is pretty low resolution, you might not see it, but that's the 61.8 Fibonacci retracement, meaning QQQ almost to the button retraced 61.8% of that entire move down off the all-time highs into the recent lows right there, right? And that is a run-of-the-mill, again, from my experience, using this for not years, decades, that is a typical range right there. Again, anywhere from the 38.2 to the 61.8. The 50 is right in the middle. And you would be surprised how often, I always do this, I always mark up my charts first with price, support, and resistance levels and trend lines. And you would be surprised how many times those levels, a resistance level that I already have drawn, once I add the fibs line up perfectly to those levels. It's much more than coincidence. Again, I don't want to, you know, my point isn't to sell you on fibs. Just tell you that I've been using them and I incorporate them in my trading, and that tells me right now. And I say that because I read the comments, and I have some of you, you know, believe or say that it's just so bullish and this, oh my God, the market just won't stop going up or won't go down. It just keeps going up and we're going to new highs, et cetera, et cetera. And I said this the other day, the market right now or lately has been no less bullish than it was bearish here, where it just couldn't catch a bid. And every time it started to rally, either overnight in the futures or intraday, just as that rally looked like it might start to get some teeth, they sold into it, and they sold into it hard. Okay, so that's the nature of a downtrend. This is the nature of an uptrend. A lot of traders fall victim to what's called recency bias, and that is the bias to believe that what is happening recently will continue only because that's the current trend. Again, I'm not a trend follower or trend chaser. I like to get in front of turns, just like I did here, just like I did here, and just like I'm trying to do now. And again, it's, you miss 100% of the shots not taken. So you know my levels where I start to be wrong, and that's where I'll start to take out of my index shorts. And hopefully I'm making money in various commodities, precious metals, crypto, whatever else at the time, or individual stocks, be they long or short. All right, so that's it. I just wanted to point out it is a perfect, and if you look at this one here, I'm going to turn this line on for you. I had it dimmed down just to make it stand out. This yellow line here, this was the first initial drop right here, which we also gained that bounce. We also went long there, traded back to the 200s and reversed and went short for the next leg down. That initial drop right here was a perfect, this is the 38.2. If you can see this yellow line here in the video, that's exactly where that one stopped. So, you know, it's hard to predict. I don't try to predict. I just look at which fibs line up and with resistance levels. And this one lines up, again, with the 200-day, again, the purple line here, the 61.8, lined up with the 200-day simple moving average, lined up with price resistance and all that other stuff. And you also have the PPO, which is a good trend indicator, the signal line, the white line, the 9 EMA, the last of the two. That is also currently back testing the zero line. Typically when you're below, you're in a bearish trend, and when you're above, you're in a bullish trend. So there's a mountain of evidence that if we go much higher, we'll take out the 200 days, we'll take out price resistance, the PPO will flip back to the bullish side, we'll make a bullish cross. Again, the signal line, I like to use a white line because that's the last of the two to cross. And so that's it. And it's, so to me, again, I'm beating a dead horse here. This is one of the most objective short levels I've seen, short opportunities in years, really, especially if the bigger picture plays out. And again, nothing ventured, nothing gained. The downside is so minimal. If all those bullish events happen, if we just go up a little bit more, a few percentage points, a lot happens. And guess what, guys? I'm going to say this ahead of time just in case it happens. Let's say they blow through the 200s, they blow through 500 on QQQ, all this happens, and I stop out. And then we do this, we turn around. Then I'll recognize for what it is. It was just a stop clearing move, and I can always get short again. Yeah, we lost a little there on the stop out, and I'll be re-entering a lower price. But I'm a very flexible trader. Otherwise, we may be going to new highs, and that's going to increase the odds sharply if we do move up above 500 on QQQ. All right, so I'm going to take this video, step it down a little quicker now. We're going to look at the rest of the Mag 8 stocks and just talk fibs, okay? Because I've covered these quite a bit on price levels. For example, Microsoft has the primary downtrend line right here. I've covered price resistance levels lately. This one has been running into since the bear market in Microsoft started. Yes, that's a bear market. The stock has fallen 26% off the highs. Call it whatever you want. To me, I think it's the initial leg down in a much larger bear market. But all I can tell you price-wise, that's a very well-defined now with at least 4 distinct reactions. Yes, these are reactions. We hit that level, stop cold, and so that's Microsoft. Now, what I wanted to do, and I have resistance levels on just about all the big FANG stocks, most of them, Microsoft being one of only 1 or 2 that's above its 200-day moving averages. The vast majority are below, and don't think for a second there that's not a big part of my analysis. It is. So you have the indexes, the big ones, S&P 500, NASDAQ 100, just about all of them, at testing or below their 200 still, and they're testing from below. That keeps them below. If you're at the 200s and you're coming back up from below, then you're still below the 200s, right? It's not a back test from above. And so you have that. Now we're just going to look at fibs. So there's a gazillion things, price resistance levels and other stuff. Microsoft, one of the strongest I had to put up. I don't always add it in, but it is one of the key. When you go to your fib tools and you go here, you can toggle on which these are the key Fibonacci retracement levels. And so again, I usually have the 38.50 and 61.8. There are times where, again, I'm looking at the Mag 8 as I always do collectively. And when the vast majority, and that's my point, are below the 200s, and the vast majority are at or below 61.8% retracements, I'm sticking with my primary thesis, if you will, that these are counter trend rallies, and we're at the tail end of what is. Because again, if we go up much more, then these guys start popping through those typical range. There's the the 38 to 61.8 right there, but this is a Fibonacci, and sometimes you'll see them push it up a little higher to the 78.6, and that's right where Microsoft has rallied into, in addition to that downtrend line. So and that's now the king of the hill. It's 3.2 trillion. It has overtaken Apple as the largest company at 3.2 trillion. But again, it's at multiple price downtrend line resistance and key fib retracement level right there. This is Apple right here. I'm just going to read off the levels. You can replicate this. Again, I'm looking at the entire move down from high to low, and I'm taking, it's the yellow level right here. I know I have different fibs up. These are fib clusters, but that's the 50%. So my Apple retraced exactly half. And again, so right now, to me, and it got rejected there as well. So again, my point is, this is nothing more than a run-of-the-mill counter trend bounce. Now, let me speak to that real quick. Everything, I say this often, everything in the stock market, everything is relative. They're relative to, so you might say, Randy, you're kidding me. This is a 26.5% rally in Microsoft and Apple. That doesn't happen. That's nothing but bullish. Again, it only retraced half of the entire move down. Everything is relative. In other words, if you go and you get a job in the NBA, and you're working on a professional basketball team, and you're working with the players, you're courtside or whatever, you're a trainer, you might be 6 foot. 6 foot is generally considered tall by a lot of people, but it's all relative. And in that work environment, you're not tall, and you're far from tall. Now you go down to vacation in Guatemala, where the average height of is about just over 5 feet. You're going to be tall down there at 6 foot. You're going to probably look like a giant basketball player to them. So everything is relative, and so that is this 26% move. That's what fibs do, by the way, guys. They put things into relative proportion. It's just half. That 26% move was half of the drop right there, and that again is typical of a counter trend bounce. That's all it is. And again, if you put up things like Bitcoin or natural gas that have, when they can run triple digits over a 6-month period, easily, 100% or more. So their moves, day-to-day moves, week-to-week moves, are a lot higher, and that's where Fibonacci's will kind of help. If you have a hard time with numbers and getting around your head that 30% drop in 2 weeks is super bearish, not in Bitcoin. 30% drop in 2 weeks in Apple would be a huge drop. So again, everything's relative, and that's what fibs do. They're putting that in relative terms. It's simply a run-of-the-mill, and that's the point of this video, showing you that this equity portion, run-of-the-mill counter trend rallies, still well below the 200-day moving averages. NVIDIA, from the highs to the lows, we're right at the 38.2%. So it's on the low end of what a counter trend bounce would normally take you at. You still have the 200-day moving averages above. Alphabet just got rejected perfectly. This is the 38.2 again. So now kind of getting the theme here. Microsoft was the first one to top out of the big Mag 7. So it got beat down. It turned early, and it's been the strongest on the way up, and that's pretty common too. You can see here so far, we're looking at most of these stocks have only recouped anywhere from a third, roughly the 38.2 fib, to about half of their initial drop down. So and look at the rejections too. I just showed you Apple being rejected off the key 50% fib, impulsive. See, guys, this is why my preference was, and I had more of a range to get, short, and I've maintained that short price, and I'm seeing evidence now. There's Alphabet getting rejected off the fib. Here's Amazon, again, from the all-time highs down to the lows. Take a line, perfect retracement. If you think this is mere coincidence now, how many stocks have I covered that are reversing almost to the button off some of these key Fibonacci retracement levels? Again, it's more than mere coincidence. This stuff works. Now, take that out. You still have the 50% fib up there. But I also look at, price resistance. Do we have anything there? 200-day moving averages. Again, you start getting above the 200s. You start getting above the 61/8s on the majority of the Mag 7 stocks. Things have changed or will have changed for me. And as of now, that hasn't happened. So let me put back the lines, go back to board 1, 2, where was I? Board 2. Meta has, from the highs to the lows, has retraced just shy. So it hasn't even made a full 50% retracement yet. Could go up a little more, 50%. 61/8 fib is right here, which is both price resistance and key fib resistance right there. And that's that. PPO is still buried down below the zero line. This stock is slightly above its 200-day moving averages. Not unusual to see a brief pop above. If it falls back below, that'll be bearish. If it continues up here, bullish, especially if it takes out the 61/8 fib. As of now, it's retraced less than half of its move up. So again, nothing unusual if this is a counter trend rally. Broadcom, 61/8 fib is right here, so it's still in the typical counter trend bounce range. If this is a counter trend bounce with another big leg down to come. Tesla is the weakest of the lot. From the all-time highs to the recent lows, Tesla right now is on its 23.6. I usually don't even put the 23.6 fib. It's the minimum one when you look at your fib tool here. That's the lowest you have right there. These are all your key Fibonacci levels. And so Tesla's been really weak. And, if it rallies up more, there's your 50% retracement level there, 61/8. It's all going to depend on what the market does, in my opinion. Okay, I'm going to give you a quick update on gold just because the last few days, I want to say, is very atypical of the top that I'm looking for. So to recap, if you're just catch up on the site. So when you look at here, I'm going to turn off all the lines real quick. I've made the case, and I firmly, it is very clear and apparent to me that this appears to be what we call a buying climax, or more of a blow off top. You cannot argue. This is not subjective analysis here. This is factual. That is a parabolic trend line. When a stock or and in this case a commodity goes parabolic, there was a linear advance right here, and at the end, this is the last bull market top in gold right here back in 2011. Gold was in a very similar uptrend, very strong uptrend. Dips were getting bought aggressively, and then at the end there, it started going parabolic. So in other words, instead of a linear advance, you had a parabolic advance, and it was accompanied by a surge in volume. That is what we call a blow-off top, aka buying climax. It's marked by a surge in volume. That's where everyone just can't resist anymore. The FOMO is too powerful, fear of missing out, and you get the last of the Johnny-come-latelys and the last of the retail, typically dumb money, piling in as the institutions unload at the top. So that was then, and I've made the case now. The problem, and I've said this repeatedly, that the thing about parabolic top, blow-off tops, and I'll have you reference the dot-com bubble if you want an idea of that. Go look at the NASDAQ composite in 1998 through 1990, or through March of 2000 is actually exactly when it peaked. And the thing about them is they can keep going for a while. There's no way to tell they're over except when you get some technical evidence. So again, you can see the same kind of thing here. We had a pretty steady advance, which has gone, well, let me draw it like that, parabolic recently with a big surge in volume. So it's indicative of a buying climax. However, what I wanted to give you an update on, now we're still above that. So on the daily chart, I mentioned that, just because you're in what may be a buying climax, you need some sell signals. And so we got a few recently. We had the island cluster top. That's what this is. Two candlesticks, an island of them separated by gaps on both sides. Then we had a bearish engulfing candle, at which point I said you can set a stop above that, because the beauty of shorting a bearish engulfing candle, it has the potential to be a topping stick as long as you don't take it out. If you do, it's no longer a top. Now, it doesn't say you can't punch through it and do that. This, I can tell you, is atypical. because why is this atypical? This move lately. And I'm just sharing you with what I see. Typically after a blow off top like that, you do get it. You're always going to get kickback rallies, but usually you get a pretty initial drop and then you fall shy of it. Usually you're not going to see a kickback rally come up to or just above. It's possible. I've seen everything. You trade long enough, you'll see them all. But that was it. And you stayed well below there. In fact, let's, for kicks and giggles, let's see how much you retraced here. I'm going to probably say the 61.8. I haven't done this. No, darn it. All right, I have to find a clean board. What happens is when I put up the fibs, there we go. Oh, do this. And I'm just curious myself right now. So that one, if I take the highs there, draw down to that first low, yeah, you can see it was right at about, I got to get that right there, right at about 61.8% retracement. And let me take that line off now. I'll leave it on. We'll just go back to the board I was working on and go back here. So this time around, you can see that something a little bit different has happened. I don't have to put the fibs up. I can tell we're close, but we're not there yet. And the trade, I said, you know, this is it. It's gold. Now, my preference, again, has been silver and GDX, as I told you. But gold is still above that, below that level. And anything above that, then you've now taken out the island top and you've also taken out the bearish engulfing. Now, there's big divergence. I would put good money that if it pops up there, you're going to just have a marginal new and still divergent high. I know that's factual because you can see the indicators lagging, and then we may go down. But again, this is just, it's atypical. That's the only word I can use to see after an initial drop like that, the strong buying with gaps again. Gold's been very gappy lately. This is just, it shows a lot of buying pressure, I'll tell you that, when you see those gaps up. However, trading plan is a trading plan, so whether you're in or not. And then the GDX, same thing I told you the other day. You can, you know, rally back to GDX, you know, objective short up to, but not above 50.12. We're on there right now. We're at 50.18. That's it. So your stops will be where your stops are. There was our divergent high, and we already hit the first target, bounce from there. So right now it's still from GDX, nothing more than the expected bounce off the first target. I still maintain these other targets. But again, if you took this or plan to take it, you want to, you know, have your stops. Wouldn't give it too much room. See what happens with gold. Again, I wanted to give you that update. And then silver's still lagging behind gold and has been. You know, silver trades very well in the technicals. Just look for these divergent highs, and then especially trend line breaks, you go long. Divergent low, long, divergent high, divergent low, divergent high, divergent high, bullish falling wedge. That was a divergent low. They're not all labeled, guys. They were in the past. We've been trading gold and silver long short off the 60-minute charts forever. And especially silver, you can see, unlike gold, silver's not going to new highs. Silver's in this big, looks kind of like the stock market. Remember back earlier this year, late last year, at least on that, when you can zoom out here, it's just kind of going nowhere. It's lagging behind. And remember, and that makes sense, gold has been a flight to safety bid. The market looking wonky, a lot of central bank buying. Silver just follows gold, tends to, but it's not the flight to safety bid asset that gold is. Silver, consider a precious metal, but it's also very much more also an industrial metal. And so if the global economy is slowing down, you're going to see less demand for silver and gold from that aspect, from the industrial acts. But there's different components of gold. There's jewelry. There's the flight to safety bid and inflation hedge, some consider it as. That's been an on-off thing. It works at times. It doesn't work at other times. All right, so there's your updates, guys. That's it. And so silver, if you want an update there, that's the most recent divergent high. You have this little uptrend line I've just added recently. We need to break that. Obviously, it would help to see gold not take out the recent highs. And if it does, again, my expectation based on the charts, you can see here the indicators are lagging. So if it pops a slightly higher high, my preference, again, with the Fed coming up on deck, give it a little room. Again, I'm going to pull all stops today on anything close like this. If it pops up And if you don't have a position, you could wait for a reversal, because that will, again, it has to be marginal, meaning a slight new high. If it goes up like this, it's going to take these indicators and it's going to burn through the divergence, and then something else may be going on. Okay, guys, that is it. That's a kind of detailed analysis on the stock market. I already gave you VIX yesterday, broke out of that bullish falling wedge. It's not really taken off yet, but it's still in my buy zone, which is just an inverse, really, if you will, of the scale back in zone on QQQ and the index shorts. And the VIX is actually holding up relatively well. It's on the only state went down to about the top third of its scale back in zone, and this has been my target. This has just been a huge moneymaker for me, and I think a lot of you on the site that took it. We were long right there at the lows with an add-on on the breakout of that bullish falling wedge. We hit my first target almost to the button. Then I gave you a scale back in zone before we even got to it right here. We went to the bottom of that zone, rocked up from there another 100%. Hit T2 with the expected pullback back into the zone, and if we go up to T3, I mean, one trade like this a year can make your whole account if you haven't. And you don't put too much in the VIX because it's so volatile. Again, beta adjust your position size down. Remember, a minute ago I said everything's relative. So this 100% move, well, we caught one back here. We were long right there at that bullish falling wedge, and I gave you 3 price targets, and that was 120%, 7%. So it's the nature of this beast. Again, everything's relative, and it goes both ways. You need to factor that in with your stops. If you're trading the VIX and you're targeting a triple-digit gain, you can't run a 3% stop loss. You will get stopped out on any given day just due to the excessive volatility. Your stops should be relative to your price target using a favorable RR of at least 2 to 1 or better, and whether you use 2 to 1, 3 to 1, 4 to 1, that's up to you. And also depends also on your entry price again, and where your price targets are. I'm going to wrap the video up here, get it out to you, and let's see what the market does after today. This has been Randy Finney with Right Side of the Chart. Have a good one.